The JetBlue Airways stock I shared with you just weeks ago is now up 95%, and it's making subscribers serious money. But here's what's wild. This airline is trading at just $4.69 right now, and it's sitting on what could be one of the biggest value opportunities in the aviation sector. Stick around because today we're breaking down exactly why this stock is positioned for a massive move. Welcome back to Velocity Stocks. I'm Sterling, and if you're new here, I hope you're enjoying the stock picks we've been sharing with our community. Before we dive into today's analysis, I need you to do two things. Hit that subscribe button and turn on the notification bell. Why? Because we drop stock analysis like this every single week, and you don't want to miss the next opportunity that could turn into a multi-bagger. Our channel is built on one thing: finding undervalued stocks trading below their true potential. We do the research so you don't have to. So let's get into it. Before we even talk about JetBlue specifically, we need to understand why the aviation and transportation sector is absolutely critical right now. Here's the macro picture. Global air travel demand has fully recovered and is now exceeding pre-pandemic levels. We're seeing record passenger volumes, but here's the kicker: fuel costs have stabilized. Airlines are finally able to operate profitably again. The aviation sector is also benefiting from massive infrastructure spending. Governments worldwide are investing billions into airport modernization, fleet upgrades, and sustainable aviation initiatives. This creates a tailwind for carriers that position themselves correctly. But there's something even bigger happening. Consolidation in the airline industry means that smaller, efficient carriers like JetBlue are becoming acquisition targets or partnership opportunities for larger players. We're also seeing a shift toward point-to-point flying rather than hub-and-spoke models, which is exactly JetBlue's competitive advantage. The bottom line: the airline industry is in a structural recovery phase, and smart investors are positioning themselves now before the mainstream media catches up. Now let's talk about the company itself. We're analyzing JetBlue Airways Corp, ticker symbol JBLU, trading on the NASDAQ. JetBlue was founded back in 1998, and it's headquartered in Long Island City, New York. What does JetBlue do? They operate scheduled air service, primarily focusing on the Northeast and transcontinental routes, with expanding service to the Caribbean and Latin America. The company employs 19,800 team members and has built a reputation for customer service and operational efficiency. Here's what matters. JetBlue is one of the few carriers with a modern fleet, strong brand recognition, and a lean cost structure. That's a rare combination in this industry. Okay. Here are the 5 reasons why JetBlue could absolutely explode from current levels. First, depressed valuation at current prices. At just $4.69, JBLU is trading at a fraction of its all-time high of $29. Even if the stock recovers just 50% of that decline, you're looking at potential upside to $14 or $15. That's a 200 to 220% move. Second, recovery from industry headwinds. JetBlue has faced competitive pressure and operational challenges over the past 2 years, but those headwinds are turning into tailwinds. As fuel costs remain stable and demand stays strong, profit margins will expand significantly. Third, fleet modernization and efficiency gains. JetBlue has been investing in newer aircraft that burn less fuel and attract premium passengers. These efficiency gains are starting to show up in the numbers, and they're going to compound as the fleet matures. Fourth, expansion opportunities. The company is strategically expanding its Caribbean and Latin American routes, which are higher margin markets. This geographic diversification reduces dependency on the competitive Northeast corridor. Fifth, potential acquisition or partnership premium. Or you think this is a risky bet on an individual airline? Understand this. Larger carriers like United, Delta, and American are all looking to acquire or partner with smaller carriers to consolidate capacity. JetBlue's brand, efficiency, and route network make it an attractive acquisition target. Takeover could mean a substantial premium to current prices. Sixth, institutional buying and short covering. The stock has been beaten down so hard that institutional investors are starting to nibble. When shorts cover at these levels, we could see an explosive rally. Seventh, positive earnings revisions. As guidance improves, Wall Street analysts will be forced to revise their price targets upward. This momentum often triggers fresh buying. Let's talk numbers because numbers don't lie. Current stock price, $4.69. That's down significantly from where it was just a couple of years ago, which creates the opportunity we're looking at today. Market capitalization, $1.70 billion. Here's what that means. JetBlue is valued at less than $2 billion. For context, a single profitable year of cash flow would represent a 10 to 20% return on that valuation. That's an incredibly attractive asymmetric risk-reward setup. Average trading volume, 17 million shares per day. That's excellent liquidity. You can get in and out of positions without moving the market. This is not a liquid penny stock. This is a major exchange-listed company with institutional ownership and real volume. Now let's look at the price action over different time frames because this tells a story. 1 month range, we've been trading between $4.50 and $5. That's a tight consolidation, suggesting we're at a potential breakout point. 6 month range, $4 to $5.50, still compressed but showing early signs of recovery. 1 year range, $3 to $8. This shows us the stock doubled from its lows but is still down 40% from the 1 year high. There's clearly room for mean reversion. 5 year range, $3 to $21. And here's the critical insight. The 5 year low is $3, just 36% below current prices. But the 5 year high is $21, which is 347% above where we trade today. The risk-reward is heavily skewed in our favor. All-time high, $29. Now, I'm not saying the stock will go back to $29, but even if it recovers halfway to $15, that's a 220% gain. The technical chart is showing a potential bottom, and we're positioned early. Before you make any decisions, I need to be crystal clear about something. This is not financial advice. I'm an educator sharing research and analysis. What I'm not doing is telling you to buy this stock. You could lose your entire investment. Aviation is a cyclical industry. If the economy goes into recession, if fuel prices spike unexpectedly, if another pandemic hits her, travel demand could crater, JetBlue could go lower, significantly lower. Position sizing is critical. If you're considering JetBlue, this should represent only a small portion of your portfolio. I'm talking 2 to 5% of your investment capital maximum. This is not a core holding. This is a speculative position with both significant upside and downside potential. Volatility is real. Airline stocks are volatile. You could see 20 to 30% swings in either direction within weeks. If you can't stomach that kind of price movement without panic selling, this stock is not for you. Do your own research. Don't just take my word for it. Read the quarterly earnings reports. Understand the balance sheet. Look at the competitive dynamics yourself. Make your own informed decision. Timing matters. The best time to buy was when the stock was at $3. The second best time is probably now. But timing markets is hard, and trying to get perfect execution will make you miss out. Dollar cost averaging into a position is a smart approach. Regulatory and labor risks exist. Airlines deal with complex regulatory environments and powerful labor unions. Contract negotiations could pressure margins. These are real business risks that could impact profitability. Let me recap what we've covered today. JetBlue Airways is a 26-year-old airline company trading at just $4.69. It's a beneficiary of recovering aviation demand, stable fuel costs, and potential consolidation in the industry. The stock has gone from $3 to $29 in the past 5 years. And right now it's trading at depressed valuations that create an asymmetric opportunity for patient investors. The metrics back this up: a $1.70 billion market cap, strong daily trading volume, and a technical chart that's starting to show recovery patterns. But risks are real, and you need to position accordingly. Conservative price target. If we see mean reversion and the stock recovers to its 1 year high, we're looking at $8. That's a 71% move. Aggressive price target. If consolidation speculation picks up and the stock recovers 50% of its all-time high decline, we could see $14 to $15. That's a 200+% move. Here's what I need from you. Hit that subscribe button. Comment below and tell me what stock you want us to analyze next. And if this video provided value, hit the like button. It helps our algorithm reach more investors who are looking for this kind of research. Remember, do your own research. Manage your risk carefully, and only invest money you can afford to lose. Next week, we're breaking down a software company that's trading at a historic discount to its intrinsic value. And the catalysts are starting to line up. You don't want to miss that analysis. This is Sterling from Velocity Stocks. Thanks for watching, and I'll see you in the next one.